Welcome to my YouTube channel, Learning Hub GH. Today we are going to look at accounting for value added tax, VAT. So we begin with what is value added tax? Value added tax is the general consumption tax imposed on the expenditure incurred in buying goods and services. It is the general consumption tax imposed on the expenditure incurred in buying goods and services. It is a tax on consumption expenditure. So the value added tax VAT is a tax on consumption expenditure. In Ghana, value added tax is administered by the Ghana Revenue Service, the GRA. VAT is collected in stages. So below is an example of the VAT system. So 1. A wholesaler sells a commodity to a retailer for $500 plus VAT of $10. The retailer pays the wholesaler $510 for the commodity. The VAT on that sale will be paid to the wholesaler by the VAT service. Say the retailer sells the commodity for $550 plus VAT of $15 to a customer. The customer pays $565 to the retailer for the commodity. The amount of VAT paid for the commodity by the retailer to the wholesaler, that's $10, is deducted from the VAT received by the retailer from the consumer, that is $15, and the difference of $5 is paid to the VAT services at the end of the month. From the example, the total VAT of $25 is paid by the customer, hence the ultimate tax is paid by the consumer. So the value added tax, it is paid solely by the consumer. So characteristics of VAT. So the first one is VAT is a tax on final consumer. So the final consumer pays for the tax. It is a tax on consumption expenditure. So you pay this tax only when you buy goods and services. It is an indirect tax. This means that it is not levied on personal income, but it is paid when you purchase goods and services. VAT is not levied on personal income. That's the meaning of it is an indirect tax. It is collected by registered persons. So VAT is not collected by just anybody. We have registered persons who collect VAT on behalf of the government. Output VAT versus input VAT. So output VAT is a category of VAT paid on goods sold and for services rendered by a firm. Output VAT is a category of VAT paid on goods sold and for services rendered by a firm. Whilst input VAT is a category of VAT on goods purchased by a business. So the input VAT is a category of VAT on goods purchased by a business. So illustration 1. A wholesaler sells goods from a producer at $300 plus a VAT at 25%. Calculate the input VAT. So it will be 25% out of $300, and that will give you $75. Illustration 2. The wholesaler sells goods to a retailer at $400 plus VAT of 25%. Calculate the output VAT. The output VAT will be equal to 25% out of the $400, which is $100. So accounting for VAT. So how do we account for VAT? In the books of accounts. So VAT changes the accounting entries for purchases and sales. The accounting entries are as follows. So 1. Where VAT is paid on purchases, that is input VAT, you debit purchases account with cost excluding VAT, and you credit creditors or cash book with cost including VAT. So I'll take it again. Where VAT is paid on purchases, you debit purchases account with cost excluding VAT, and you credit creditors or cash book with cost including VAT. And you also debit VAT account with VAT on purchases. The second one, where VAT is charged on sales, that is output VAT. You debit debtors or cash book with sales price including VAT, and you credit sales account with sales price excluding VAT. You also credit VAT account with VAT on sales. So I'll take it one more time. Where VAT is charged on sales, that's output VAT. You debit debtors or cash book with sales price including VAT, and you credit sales account with sales price excluding VAT, and you also credit VAT account with VAT on sales. Where VAT is paid, that's output VAT exceeds input VAT. You debit the VAT account and you credit cash book with the amount owing on VAT. So I'll take it one more time. Where VAT is paid, that is output VAT exceeds input VAT. You debit VAT account and you credit cash book with the amount owing on VAT. Where VAT is received, that is input VAT exceeds output VAT. You debit cash book account and you credit VAT with the amount received on VAT. So where VAT is received, that is input VAT exceeds output VAT. You debit the cash book and you credit VAT with the amount received on VAT. So VAT returns preparations. So this is the format of a VAT returns. So first output VAT, then you less input VAT, and then you get the amount paid or received. So illustration 1. Assuming an output VAT of $25,000 and an input VAT of $19,000 of Learning Hub GH. Prepare the VAT returns. So this is a solution. So the first step is you write the name of the company or the business, Learning Hub GH. And then you write under it what you are preparing, VAT returns. So you start with output VAT and the amount is $25,000. Then you less input VAT. The amount is 19,000 US dollars. Whenever you see a figure with a figure in bracket, it means you're subtracting. So 25,000 minus 19,000 give you $6,000. So amount paid to VAT services is 6,000 US dollars. So this is the end of the lesson.